Hey, Jeff McAlister here with Cornerstone Home Lending. Hey, just wanted to take a couple minutes, and this one's going to be a little bit long, so hang with me, just to talk about what the Fed has done as far as raising short-term rates. I'm sure y'all heard on Wednesday the Fed raised the Fed funds rate by 0.25%. In addition to that, they're talking about raising it 7 more times each time they meet the remainder of the year, and raise it each time again. So let's assume for a moment it's just 0.25%. We're going to see a 2% increase in the Fed funds rate. So I know everyone's like going, oh my gosh, 30-year mortgages are going to go up by 3 or 2%. The Fed funds rate has nothing to do with long-term mortgages, and I'll explain that. Mortgage-backed securities are sold in the bond market, bought and sold, has nothing to do with what's going on with short-term rates. So bad news. Interest rates for 30-year mortgage since the beginning of the year have gone up, and have gone up fairly significantly. I want to show you this by looking at this first chart. You'll notice on this first chart dated January 3rd, the 3.5 coupon for the mortgage-backed security was at a price of 105.18. Fast forward, look at this next chart. March 15th, they were at a price of 100.69. That is a difference of 449 basis points. What does that mean by interest rates? You're looking at a difference in interest rates for about 1.25 to 0.38 difference between January 3rd and March 16th. January 3rd, we were probably around mid 3s. Now we're mid to higher 4s, going close to 5. So you can see a 0.25% change in the Fed funds rate had nothing to do with what's going on with the 30-year mortgage rates. So why are 30-year mortgage rates going up so fast? One word: inflation. So inflation is the arch enemy of mortgage-backed securities, and so as a result, we're seeing 30-year mortgages going up. The good news is actually what the Fed is doing by raising the short-term rates is fighting inflation. So the bond market is actually reacting positively. We've actually seen a slight improvement the last couple of days because of this move. So now it begs the question, what's next? So let's do a little history lesson. The goal of the Fed in the actions that they're taking is to slow down the economy. They do this by raising short-term rates, which is the rates that banks charge each other for overnight borrowing. It also affects credit cards, car loans, lines of credit, those sort of things. It's made it more expensive to get that lending, so as a result, people buy less, then it slows down the economy. As a result, inflation should drop. Now, the Fed's done this twice before. Back in the 1980s, Paul Volcker was the chair at that time, and interest rates were through the roof, as well as inflation. He hiked the Fed funds rate from 11% to 20% over 2 years. Keep in mind, in relative terms, the Fed just raised ours to a half. So much different economy then, but just want to show you what they did how it resulted in things. It dropped mortgage interest rates from 14 to 5%. So clearly the actions worked. In the late 1990s, Alan Greenspan did the same thing. He hiked the Fed fund rate from 4.75 to 6.5, dropped inflation from 3.5 to 1%. So in both cases, the actions of the Fed did work by slowing down inflation. However, there was a cause that created by that was that each time the economy went into a recession. So now we've got to ask the question, are we headed for a recession? And now before you start panicking, going, oh, we're headed for a recession is not necessarily a bad thing. It's part of a normal, healthy economic cycle. You can't just have an economy just continue to go straight up, or we need some checks and balances. But we need to know, are we headed for a recession? Well, we have some indicators that can tell us that or give us some ideas if that's going to happen. One of them is the yield curve. And what a yield curve does just shows, it's a graph that shows long-term rates versus short-term rates. So here's an example of a normal yield curve. You'll see on this graph that you have yield on the left and then maturity on the bottom of your horizontal and vertical axis. And as the maturity increases, the yield goes up. That is a normal yield curve. Shorter time, lower rate of return. Longer term, higher rate of return. So now what we're starting to see is what's called an inverted yield curve. So take a look at this next slide. You'll notice with the two red arrows, that's comparing the 10-year versus the 2-year. we're getting dangerously close that the 10-year is actually getting lower, meaning a lower yield than the 2-year. We're actually already lower than the 7-year. Take a look at this next slide. You will see this is the 10-year versus the 7-year yield going back to before 2014. Back in about late or early 2020, you will notice we were in a recession and the yield curve actually was inverted. And you'll notice also right now it's inverted right now. So now let's look at the 10 versus 2-year Treasury chart. You'll notice lots of red lines on there, and the red indicates that the 10-year is actually lower than the 2-year. So we have an inverted yield curve. We have superimposed gray bars. On each of those gray bars shows a recession. This means that every time that the 10-year Treasury has gone below the 2-year Treasury or inverted, we've gone into a recession every single time. You'll notice on the far right where the circle is, we're getting dangerously close to that happening. So what does all this mean? I know it's a lot of charts and stuff of that nature. Well, history has shown us that every time that we've had a recession, well, let me show you this next slide. 30-year rate mortgages have actually gone down on the backside of the recession. So what does this all mean? We think that there's a good chance that interest rates could go down if we actually go into a recession based on what the Fed is doing right now. The Federal Reserve needs to step in and lower inflation. What will the result be? In the event that it does become a recession, then we feel that there's a possibility that interest rates could go down as time goes on. So hope that helps. Nice little history lesson. Thanks for taking the time to hear me out. If you have any questions, you want more detail, please let me know. Happy to help. Talk to you soon.